Did the second wave of bank failures just begin? Well, on Friday, November 3rd, Citizens Bank was placed into FDIC receivership, which begs the question, is this just a one-off, just a collapse of a small, unimportant bank, or is this the start of something bigger? Well, first, it's important to note that this Citizens Bank should not be confused with the first Citizens Bank that acquired Silicon Valley Bank earlier in 2023. Not only that, it should also not be confused with this Citizens Bank, which has a market cap of $12 billion. So if you're sitting there thinking, man, I've got an account at Citizens Bank, how did I not know they failed? They probably didn't. You're probably banking with a different Citizens Bank. In fact, there are about 155 banks with the name Citizens in their name, and 13 of them are actually just called Citizens Bank. So odds are your Citizens Bank did not fail. The Citizens Bank that did fail had two branches. They're located in Iowa, and they had about $66 million in assets and $59 million in deposits. So make no mistake, this is a tiny bank that many people would consider unimportant. That is, unless you had over $250,000 in a bank account with them. But we can't just stop there. In order to be able to answer the question whether this is the start of a second wave of bank failures like we had in early 2023, we have to see what is really going on under the surface that caused this bank to fail. So first, how do banks work? Well, number one, they don't actually have your money. In fact, the way banks work is they're always 100% of the time insolvent. Because when you give your dollar to a bank, they do not just hold it there. If they did, they would have to charge you a substantial fee for that because they've got to keep the lights on, they've got to pay the bills, they've got to pay their employees. And so what they do is take your dollar and purchase an asset with it. Many times this is just another form of debt, so they're loaning it out or they're purchasing existing debt, which means that you and everybody else who has your money in a bank account, if you guys all go try and take your money out, it's not there. The bank has taken it and done something else with it. They keep a small fraction of the deposits available so that they can meet the demand for regular withdrawal requests. And so that's why this is called fractional reserve banking. Now, in normal environments, this practice works out fine because people give their money to the bank. They don't know what's going on. They get their little bit amount of money out whenever they want, and they keep on going along life as normal. But over the last couple of years, as interest rates have risen at the fastest pace in modern history, things have been anything but normal. And like I mentioned earlier, most of the assets that banks purchase are debt instruments. And so if I purchase a debt instrument at 2% with $100, I'm going to get $102 back. But let's say the next day interest rates go up to 4%. That means for somebody else to get the same $2, they only need to invest $50, which means if I then, for whatever reason, need to sell the debt instrument that I just bought that will only pay $2 at maturity, I can only sell it for $50 because now that's the going rate for money. So all of the banks that loaded up on debt during 2020 and 2021 are underwater right now because interest rates are higher, which means their portfolio of assets, which is debt, is worth a lot less than it was than when they purchased it. This is why even large banks like Bank of America are sitting on massive piles of unrealized losses, with Bank of America sitting on $131 billion in losses right now. And Chase is sitting on $40 billion of unrealized losses. And so a couple of years ago, if everybody decided to pull their money out of the bank at the same time, there's a good chance that that bank would be able to sell enough of its assets to meet all the withdrawal requests. Today, for most banks, that's not possible because all the assets they would be selling at less than what they purchased them at, which means they simply wouldn't have enough to meet all the withdrawal requests. Now, this is where the FDIC comes into the process. And throughout the rest of this video, I'm going to explain to you precisely and exactly how your money is protected, what happens to it when a bank fails, like for all the depositors at Citizens Bank, and alternatives that literally anybody can use to protect your money and also make more on it than what you get at a bank account. But first, let's look at an alternative to the banking system entirely with today's sponsor, OneGold. Because in uncertain economic times like today, there's simply no better way to preserve your purchasing power than purchasing precious metals like gold, silver, and platinum. Now, years ago when I started my YouTube channel, I was still talking about gold and silver, but you guys were the ones who actually told me about OneGold. I was looking for an easy to use platform to purchase segregated, allocated gold and silver at a cost-effective price, and OneGold simply delivered. Their gold, silver, and platinum are all fully allocated and physically segregated. It is also fully insured through Lloyd's of London, and they have regular third-party audits. The reason why they do this is to prove to you that what they say they actually have, they have. Whenever you're dealing with precious metals in storage, you always want to minimize that counterparty risk as much as possible. And that's exactly what OneGold does. Not only that, but it is incredibly simple for anybody to use. Simply open up an account in just a few minutes. Then you can look at the products available to you between gold, silver, and platinum, and then you can purchase your precious metals using a variety of funding sources. At any time down the road, you can choose to either redeem your physical metal and have it sent to you via sister company AppMex, or you can sell your metal, which can be liquidated 24 hours a day. Once you sell, then you can withdraw your funds back to your bank account. My preferred way to use OneGold is for dollar cost averaging, taking a small amount of money, purchasing at regular intervals to take advantage of the gold price volatility. And then once I have a stack that's large enough for a couple ounces, I'll request physical delivery. And if you use the linked code in the description below, you'll get a $5 bonus to open up your account. So start purchasing precious metals today using OneGold. So what exactly happens when a bank fails? How does the FDIC step in and help? Well, in the case of Citizens Bank, ownership was transferred to Iowa Trust and Savings Bank. The two branches that used to be Citizens Bank will reopen as branches of Iowa Trust and Savings Bank. Checks will continue to be processed, loan payments will continue, and customers do not need to change their banking relationship. And this is what always happens when a bank fails. For anybody who does not have more than $250,000 with that bank, it is business as usual. Nothing changes except the name on the website, the name on the door, and the name on the checks. Probably the name on the debit cards too. The losses were absorbed by the FDIC for the cost of $14.8 million. Now, this was a tiny bank, which means that the bailout process, the transfer, the purchasing, no big deal. There are plenty of banks that were bigger than this one. The trouble happens when the failures are from a very large bank where there are very few that are even larger. This is because the deposit insurance fund at the FDIC has nowhere near enough to cover those large banks. The FDIC has about 2% of all deposits in its deposit insurance fund. Basically, if the FDIC was forced to bear the brunt of just Silicon Valley Bank in early 2023, it would have wiped out its entire fund. In cases like this, the Federal Reserve steps in and prints the money necessary to fill up those bank accounts again. But again, for anybody under the $250,000 limit, this does not affect them either way it happens. But what happens if you have more than $250,000 at a specific bank and that bank fails? Well, following the financial crisis, the way that works is that you get bailed in. So what is a bail-in and what does it mean for your money? Well, when you deposit your cash in a bank account, you are a creditor. You are a lender to the bank. They owe you that money back. Now, in the case of a business closing down, the owners of the business have to pay the debt first before they can take anything. Imagine you and your business partner, you start a business and you take out a loan to help you start a business. A year later, 2 years later, it's not going the way you want. Something happens, you decide to shut down, you liquidate all the assets. Let's say you owe $50,000 in debt and you sell everything for $100,000. Are you allowed to just walk away with that $100,000? No. First, you have to pay the debt off. After you pay the debt off, you now have 50 grand left over you and your business partner can split. If you can only sell everything for 50 grand and you owe 50 grand, you still have to pay it back and you walk away with nothing. This is how it works with a home and a mortgage, with the equity versus the loan. This is how it always works. The creditors, the lenders are in front of line of the owners. So in the case of a bank failure, the lenders, which are the depositors, get their money back first. So the bail-in actually turns the depositors into owners. Anything over that $250,000, you become a shareholder with that amount, which basically just means you're probably not going to get anything back because the owners lost everything, the bank failed. So rapid fire, let's go over 3 very solid solutions that literally anybody can do to make sure that you never lose money in a bank failure. Number 1, never keep more than $250,000 at a specific bank. If you have $250,000 at Chase, you have $250,000 at Bank of America, $250,000 at Wells Fargo if you hate yourself, $250,000 at a bunch of different banks, all of those are covered. It's per bank, per person. Now, if you have a couple million that you need to keep in cash, this can become unreasonable very quickly. This brings you to the second option, which is money market funds. Money market funds are through brokerage accounts, and when you put your money in a money market fund, it operates similar to how a bank operates. Your money goes into the fund and then it goes to purchase short-term US government treasuries. Just how when you put your money in a bank account, it gets used for, other purposes. The difference is money market funds are always only extremely short term because they're meant to be extremely liquid, which means that there are no money market funds that are underwater right now versus pretty much every bank that exists is underwater. So currently money market funds carry almost no risk. They're not carrying any losses. Even if everybody withdraws their funds from a money market fund, all the assets get sold immediately, no losses. On top of that, they pay way better than bank accounts. Right now at Chase, regardless of your balance size, you're not gonna get more than 0.01% on your cash. Compare that with Fidelity's money market fund that is currently paying 4.99%. So less risk, higher return, win-win. Now, if you want to skip the middleman and go straight to the source, the third option is going to be T-bills. T-bills are a type of loan directly to the United States government. It's a type of treasury that is extremely short-term, 4 weeks to 1 year. Currently, T-bills are paying anywhere between 5 and 5.5%. And you can construct a nice and easy ladder so that every month you have some maturing. And by the way, pretty much everything in this video is a very, very tiny sliver of my cash management playbook course that is available to members in addition to every single other course that I've created in Heresy Financial University. So if you want more on managing your cash to be able to increase your returns and decrease your risk with your cash savings as well as the rest of your portfolio, become a member today. It's $99 a month. And starting next year, the price is going up, but it's staying locked in for members forever. So you don't want to miss out, get in now. And finally, we have to ask the question, why are bank failures happening now? And is this a sign that we have more to come? This is a chart directly from the FDIC that shows all bank failures going back to 2001. And what's very interesting on this chart is looking at the years 2005 and 2006, the years preceding the financial crisis, you'll notice had 0 bank failures each. That is quite an anomaly to have 2 years in a row with 0 bank failures. But even stranger is that if you look at the years 2021 and 2022, we also experienced 0 bank failures in both of those 2 years. History doesn't repeat, but man, it sure does rhyme. Because following the 2 years with no bank failures, we saw an unprecedented historical spike in bank failures with 3 failures happening in 2007, 25 the year after, and more the year after that, with the majority of the dollar losses happening in the beginning. Similarly, in 2023, we saw 5, now 6 bank failures with dollar losses exceeding everything we saw in 2008, which means that if the pattern holds true in the coming year, we will see a massive spike in the number of bank failures, despite the fact that the dollar amounts being lost will be lower than 2023. Consider the pattern again, a couple of years of normal bank failures with a 2-year lull of 0 bank failures. The next year we see a spike in bank failures considering the dollar amount, and the years following we see hundreds of banks failing even though the dollar amount is lower. Following the same pattern, we see a couple of years of normal bank failures with 2 years of 0 bank failures, followed by a year with a few bank failures and a massive record amount of dollars lost. We would expect to see the next couple of years have hundreds of banks fail even though the dollar amounts are smaller. Considering the fact that number 1, small banks are not too big to fail. So they will be allowed to fail because the deposits will be absorbed by larger banks. And considering number 2, that a consolidation of banks and fewer banks in existence is good for central planners. It makes their job easier. They like that more. They're not inclined to try and save every single little small bank. They would enjoy fewer, bigger banks. More control. And number 3, the majority of the distressed assets right now are in commercial real estate. Office space especially has been hit hard. Commercial real estate owners are underwater on all their loans. And over the next year to 2 years, they're all coming up and maturing. Most of these commercial real estate loans are isolated at regional banks, and they're concentrated with a small minority of these banks, which means that almost certainly we have more failures to come. Even if the total dollar amount is smaller than it was in 2023, more banks will fail, more bank consolidation is to come. If you don't have more than $250,000 in any bank account, you will be fine. Your dollars will just be moved to a different bank should your bank fail. But if you have more than $250,000 in a specific bank, or if you just want to increase your returns while also decreasing your risk, consider the options we discussed in the earlier parts of the video and explore Heresy Financial University for more. As always, really appreciate you guys. Thanks so much for watching. Have a great day.